Nicholas, thank you very much indeed. My name's Lyndon Harrison. I used to chair for 5 years the relevant committee of the House of Lords, the Economic and Financial Affairs Subcommittee, reporting to the Select Committee of the House of Lords. And it is we who publish the report which you have before you, the Capital Markets Union, and it itself stemmed, as it was printed earlier this year, from this tome, the post-crisis EU financial regulatory framework, do the pieces fit? And the specialist advisor on that occasion was none other than Professor Niamh Moloney, but it came from that. So we are very happy to have Niamh here this morning to lead off on the Capital Markets Union. Just to say that in the House of Lords next Tuesday, as ever when we publish a report, we have a debate on it, and there will be a debate on the Tuesday. So those of you who haven't gone viral as a result of the location you find yourselves in this morning and still want to look in on those who are going viral, please do look in on the House of Lords monitor for next Tuesday to get a little more about the new regulatory framework. But into that regulatory framework does fit the Capital Markets Union. What I should say about that is that we have home advantage as the House of Lords because, of course, the new European Union Financial Commissioner is none other than Lord Hill of Orphan. So we bagged first rights to interview him, which we did, and he was very good as a witness, and as an old hand with European Union affairs, he used to work with Prime Minister Major for many years. He is recorded in here. The second thing that we did was we held a seminar of many interested parties, and that too is found within the body of this report, where we had such luminaries as Jonathan Fall, Michel Barnier's right-hand man until very recently when Barnier was still the Financial Affairs Commissioner, and the indomitable Sharon Bowles MEP, who chaired the appropriate Finance Committee, EMAC Committee within the European Parliament. And they were amongst a number of colleagues who came and gave us a free view of their thoughts and views of the Capital Markets Union. So in addition to what you will hear from Professor Moloney, do feel free to consult this. I have one report spare if anyone would care to nick it, but it's always online and you can get it. So I think without further ado, Niamh, if you'd be kind enough just to speak for 20 minutes, 25 minutes or so on the subject and give us a good flying start before we commence.
Thanks so much, Lord Harrison, and to Nicholas for the invitation to speak. So I think as the first speaker, I thought I would take a sort of a helicopter view of what CMU is all about to sort of set the frame for the discussions later today. So I think we're all familiar with what it is designed to do, but perhaps just a quick reminder, and then I'll go into it a bit more. So it's associated with a number of things. So an increase in and diversification of funding sources. As you all know, there's a massive contraction in bank lending at the moment. Kinds of things we're talking about are loan origination by funds, perhaps, and more generally, much stronger market-based funding, securities-based funding. More specifically, this is leading into issues such as supporting what Europe tends to call simple securitization, and the reason for that, of course, being allowing loan assets off balance sheet, thereby freeing up lending capacity. Broadly speaking, we don't really have a good sense of how this is going yet, but it's sort of regulatory support for simple and safe, high-quality securitization, and also reviewing existing rules and how they play to securitization. Also supporting stronger private placement markets. Here, I think, not so much regulation, but supporting the market. You know, how might the market be encouraged to deliver more standardisation in this area. Possibly one that gets a lot of attention is SME funding. So, for example, should we move to IFRS reporting standards for SMEs, SME securitisation perhaps, credit scoring for smaller firms to make it easier to raise funding, and perhaps most controversially, getting retail investors, household capital, if you like, into SMEs as risk capital. There's a couple of other things I think we can easily associate with it, and that's deregulation of the EU's Prospectus regime, very much associated with SME support, and often aligned with President Obama's US Jobs Act reforms, which is the single biggest deregulation of US securities law since 1933, but that is a very different context. I mean, the size of an SME in the US is multiples of the size of an SME in Europe. Crowdfunding, I've italicized that because these are sort of regulatory measures we're seeing here. Looking at the coherence of securities market law generally, facilitating market access for EU firms to third countries, so issues in and around equivalence and sort of reciprocity between states. But, and you'll see this as I go through, and I may as well be upfront about this at the start, I am deeply sceptical about CMU. So my question is this revolutionary, is it new, is it even necessary? So let me just start with a very quick recap and just place some of this in context for the day's discussion. In terms of where we've been for the last sort of 7 or 8 years or so, we've obviously had massive institutional reform in Europe, with the European system of financial supervision for the single market generally, and of course banking union for, broadly speaking, the euro area. We've had a wave of regulatory reform. The first wave was very much financial stability, with a very strong connection to the G20 agenda, but there are these add-ons, classically the short selling regulation and the AIF&D, colloquially the hedge fund regulation. And the second wave from about 2011 is where you see the momentum pushing out, it's pulling in other issues, consumer protection on securities markets. The third wave of the crisis sort of era generally, around about 2012 on, we get the focus on growth and market efficiency and so on. So we see reforms to fund regulation and of course classically MiFID II, the huge securities market measure, which also has particular rules in there for SMEs. And then at the very end of this, of course, last summer, we get the push to Capital Markets Union. So just for the kind of the trajectory of this. Now let's put Capital Markets Union, this box with a big ribbon on it, which is how I really see it, but I think what it's actually doing is packaging an awful lot of other stuff. So we have had an awful lot of capital markets reform aside altogether from CMU over the last number of years. So sort of following sort of the trajectory, so we've got the classic crisis era reforms for the securities markets. 2011 we have the AIF&D, 2012 short selling, 2012 also EMIR, the huge OTC derivatives market measure. Then we get sort of the MiFID II, MiFIR rules in 2014, also the market abuse rules, of course, around the same time. Shadow banking, progress finally been made on money market funds in Europe. And then as we sort of push out of the sort of disaster management phase, we get into sort of politics and the usual sort of squabbles about what do we mean by markets? Which model of market are we looking at? Are we all very annoyed with the city? You know, these kind of dynamics are always there. And the House of Lords, of course, reported on the financial transaction tax, which I put in here as sort of outside the crisis, but really this is politics. The financial transaction tax, no unanimity in the Council, so this is proceeding under enhanced cooperation for a smaller number of member states. And there was a challenge by the UK to the European Court, which was rejected, not so much on legal grounds, but as not being ripe, that the measure hasn't yet been adopted. And then again, staying out of sort of the crisis measures, what I'd sort of term business as usual. You know, we have a highly dominant EU in financial markets. It holds the pen, and it's very clear that it does so. So whenever there's a sort of an explosion in some part of the financial market, the EU just moves in now pretty clearly. You know, there's really very little pushback from the member states. Probably the most recent example of that is the benchmark regulation. So we had the explosion with all the indices problems a couple of years ago. There was really very little question over the fact that this was the EU. So you wouldn't get the member states really reacting in a legislative way. The EU would move into that space. So that's sort of, if you like, our bundle of reforms pre-CMU. So an enormous amount of regulation already. And then if you look at sort of capital markets from an institutional perspective, over the last sort of 7 or 8 years, we have the creation of ESMA, the European Securities and Markets Authority, with a range of supervisory and regulatory powers, the European Systemic Risk Board, and the national authorities, forming this sort of network for capital markets. This has led to enhanced network coordination with respect to securities market supervision, and also, of course, direct supervision, the big change. Our newish regulator, ESMA, with direct supervisory powers over rating agencies and trade repositories. Just note here as well, it's slightly more under the radar, but I think very important. Financial reporting is becoming increasingly centralised. And that is the glue, that's the language that is underpinning all of this. So ESMA is taking more control here, so is the ECB. So from a sort of an institutional perspective, financial reporting is really pushing into the centre. Now, with respect to banking union, of course, that's not a capital markets measure, that's a securities measure. It's a banking measure, the single supervisory mechanism in particular. But of course, it would be impossible not to allow or not to concede at least some spillover effects. It is limited to prudential supervision, but conduct risk, which Professor Bryan's going to be talking about shortly, is part of risk supervision. And it's very hard to draw the line exactly between prudential supervision and conduct supervision. And financial reporting, which we classically associate with the capital markets, very, very important now on the banking side, with IFRS 9, of course, coming into play in the next couple of years. I think the other element of capital markets regulation we have, of course, is crisis management and resolution. Now, some investment firms, a fairly small group, but some investment firms do come within banking union in this respect. They come within the BRRD, the Resolution Directive, and they also come within the Single Resolution Mechanism. Now, it's very few. They kind of get pulled in through a couple of sort of group-related legal devices. So there are a couple of them in there. But for everything else, really, the vast population of investment firms, stock exchanges, CCPs, pretty much everybody else in the capital markets, that's very far behind. So there's sort of consultations out there, it's under development. Probably the one to watch is ESMA's coordinating role with respect to CCPs, the new kind of nuclear power stations of the financial markets. They're supervised at national level, but ESMA does have this coordinating role. So that's where we are, without even going near CMU. All this has been happening. So situating CMU within that then, what might we say before we sort of look at it? Well, clearly, and this is sort of nothing new, but EU financial governance, we know from the last 6 or 7 years, and we've known for about 50 years, really, is highly dynamic and it's highly experimental, always has been. But there is a certain sense in which we shouldn't read from one to the other. So, banking union, classically, the big development we've had, and capital markets union are very, very different animals. They have very different drivers, they have different constitutional contexts. You've got the single market for CMU, the euro area sort of complications for the SSM. So I think we need to be very careful, even allowing for dynamism and experimentalism, from predicting from one to the other. So I think that's certainly sort of one sort of way we can situate CMU after the last number of years. I think another way we can situate CMU is April 2014, which is when we got the last meetings of the European Parliament before the new Commission and Parliament took place. And there was a Tuesday meeting in April where they got through the last big raft of measures, and almost immediately it became called Super Tuesday because a whole load of stuff went through on that day. That's really the high watermark of the crisis programme. And now, as what Jack Coffey would describe as the sine curve, there's no doubt it's moving down. There's sort of an inevitability to that. So again, CMU is sort of part of this. So there are all these deregulatory indications around at the moment. So a lot of the crisis measures are being reviewed. There's a lot of focus on review and assessment. The tone of the initial assessment, so the Commission did one last year, ABA did one just a couple of weeks back, is sort of, watch, review, assess, calibrate. It's not new measures, it's sort of let's sort of see where we are. The European Parliament has just launched a major inquiry into what does the crisis programme look like. And another deregulatory hint, if you like, is, and again, this is all before CMU, a strong focus on SMEs. That's really been part of the debate now for the last 2 or 3 years. For example, during the negotiations on EMIR, there was a lot of concern that smaller companies are coming within the very tough hedging rules that apply for OTC derivatives, and there's a lot of concern to protect them. And MiFID II, of course, we have the special stock exchange, the SME growth markets. That was all in play. So, you know, I think we need to situate it in that sort of space. Again, looking at the political economy of where the last 7 or 8 years would put CMU, I think there's no doubt that there is a lot of pressure right now on the single market consensus. So, as far back as 1966, which is when all this starts with the Sequoia report, we've all been pretty much on board for a single market in securities, a single market in financial services. That's come under a lot of pressure in the last 5 or 6 years. And the reason is, because as the programme pushed out, and it really began to kind of pick out the dark corners of the market, or perhaps more kindly, the more sophisticated parts of the market, they are specialised. So they're located in London, Luxembourg, Frankfurt. You know, they're not pan-European. So as the programme is pushing out and becoming much more regulatory, you're not necessarily getting the same kind of single market benefits, but you're getting a hit in terms of regulation. So for example, the short selling regulation, I think it's close to 50% of short selling takes place out of London. So London will see this as well. You know, we're really being hit with the regulation here, and where is the single market benefit? So the consensus is kind of weakening a little bit. Suspicion of intense financial intermediation is definitely out there. We have much stronger stakeholders in the non-industry space. Finance Watch would be probably the biggest one. The financial transaction tax tells us certainly that some member states are very sceptical about financial markets. We've also got the euro area caucusing issue. Are they clubbing together because of banking union? And there's various ways of dealing with this. The European Banking Authority has different rules to stop the SSM cohering together. A few of you might have noticed a major victory for the UK a number of weeks ago when the European Court of Justice said the ECB could not actually require that clearing platforms couldn't be required to be based in the euro area if they were clearing euro area instruments. But there is this sort of worry about discrimination that we've really never had before. So there's all this sort of political economy going on. Other parts of the political economy are sort of difficulties with the AIFMD. I mean, this is the bogey measure for the UK. It has caused a lot of difficulties for the fund industry, and in particular, and again, if we situate within CMU, for venture capital and private equity. And they are real drivers, they're escalators, they're funding escalators to get you up into the markets. So ever before we got to CMU, there's concerns about the regulatory programme kind of blocking or causing difficulties for venture capital and private equity. And then we're getting kind of issues and pressures about how we do institutional design for the capital markets. So some constitutional worries about ESMA and rating agency supervision, and some constitutional worries about ESMA and its role in short selling, which the court actually did support in the end. So I think pressure, pre-CMU, pressure kind of building in a couple of places about EU financial markets generally. So that kind of takes us really up to last summer, which is when all of this sort of goes live. And I mean, my question is, well, okay, that's Capital Markets Union, and that's very exciting, and it's very new, and although I don't think it is, based on the last couple of slides. I think we've been doing this now for a very long time. But then I wonder, if instead of calling it Capital Markets Union, what if we called it a single market in capital? Is that the same thing? Because if you just turn around the words, we've been doing that since 1966. You will find that language, a single market in capital, absolutely fundamentally front and centre to every major measure the EU has done. Now, 66 is when we get the Sequoia report, the first time we get the EC, as it would have been then, talking about the importance of market finance. So it's very much, it's an interesting report. Obviously the world was different in the mid-60s, but they did talk about this. Market finance is important. We want more funding through the markets. Phase 1 of European capital markets law, the late 1970s, and then into the phase 2 in the late 1990s. You're getting all these securities measures, and they're all saying the same thing. All really from the 70s on. We need to wean the EU from bank finance. You get an awful lot of statistics about the dominance of bank finance. You get a lot of talk about a liberalised regulatory infrastructure. You even, this is in the mid-80s, you get this ambition that Europe, not the market, but that Europe would build a pan-European stock exchange. Now, we don't do that kind of thing anymore, but that was sort of out there. You get these constant exhortations. We must build a retail investment culture. This is constantly out there. And you get a whole series of reports which talk about market finance and how that can be supported. And probably most significantly, in the early 2000s, you get all of these absolutely critical measures which are specifically designed to drive market finance and to drive, a single market in capital. It doesn't use Capital Markets Union, but it does talk about a single market in capital. And even in the crisis era, before we get to last summer, it's the same thing is going on. So an SME growth market, so in other words, a trading platform, a vehicle, a legal vehicle, which makes these kind of things possible. For an SME growth market under MiFID II, as I mentioned earlier, EMIR, we get changes to disclosure to support SMEs, and you get new products, so new funds are kind of constructed. In particular, the European Long-Term Investment Fund to support capital raising, and you also get the European Venture Capital Fund and the European Social Entrepreneurship Fund. So all those funds were constructed, legally constructed, in the last sort of year or so before we ever hear of CMU. So my eye is sceptical. I think we've been doing this since 1966. It's been happening in very distinct phases. And I think if we call it a single market in capital, there's really sort of nothing particularly exciting about CMU, but there might be a lot of risk. So with that then, what is it? So we've had all of this already, but what is this CMU? Well, I think we're all probably familiar, but perhaps just to frame the day's discussion, I think I've got about 5 minutes. The Green Paper, which came out, it was heavily leaked, which is always interesting. Whenever there's a big discussion, it will get very carefully leaked. So I think everybody knew what it was before it came out. So there were 5 priority areas. There are 5 priority areas. Lowering barriers to access to finance, and the big focus here is on the Prospectus Directive. Widening the investor base for SMEs, and the big focus here is credit scoring, so making it easier for SMEs to get credit. Building sustainable securitisation, boosting long-term investment, and developing European private placement. So they're kind of the 5 priority areas in the Green Paper. Now, supporting those 5 priority areas, there are different measures, so sort of the way to get there, if you like. The first of these group around improving market effectiveness. So through the single rule book, in effect, all those measures I mentioned, a little while back. Looking at enforcement of securities law, ensuring it's implemented correctly, looking at supervisory convergence, data and reporting. What I think I'd call housekeeping, just shaking up us there and making sure it works. Looking at market infrastructure and securities law, that's things like clearing rules and insolvency rules and so on. You can see there company law, taxation. And then improving access to finance, SME support, peer-to-peer lending, corporate bond issues. So they're the kinds of measures the COM has in place. And then developing and diversifying funding supply, boosting institutional investment through funds policy, and boosting retail investment through cross-border retail funds, and possibly giving ESMA more power in this area. So it's quite generally framed. Now, sitting sort of underneath the Green Paper, there are a number of specific consultations. So, for example, there's one on securitisation. There's also one on the Prospectus Directive. So just to give you a feel for what a particular part of the CMU agenda looks like. So the Prospectus Directive reforms are strongly deregulatory, when you look at them, but not always. It's sort of a mixed sort of measure. But they are very strongly SME facing. That's very clear when you look at it. So the kind of things you see in the reforms are adjusting the exemption thresholds. So if your offering is below 5 million, no prospectus. So looking at increasing that, so making it easier to access the markets without a prospectus. Probably the biggest one is exemptions for secondary issuances. So if I've already done a public offering and now I reissue again on the markets, that I wouldn't be required to supply a prospectus. because there's already a lot of disclosure out there about it. A coherence, just trying to tidy it up a bit. Trying to look at bond market thresholds, the rules that apply to issuing a bond prospectus. And this one I think is deeply problematic. So this is not deregulatory, it's the other side of it, very regulatory, requiring a prospectus if you list on an MTF. Now, MTFs are sort of the second tier markets in the EU, and previously you didn't need a prospectus for these because they're different kinds of markets. I think that's very problematic because it really disrupts what we mean by a regulated market, the top tier market in the EU. But they're the kind of things coming through under the Prospectus Directive. So, we've had this single market in capital going on for a very, very long time. We have had over the crisis era an awful lot of regulatory, institutional and recovery activity around capital markets. So I think if you think in terms of a single market in capital, yeah, we've been doing this. Now, the danger is when you shift it around and it becomes CMU and it sounds like banking union and it's all very interesting and the FT is there and there's, it's a huge, big thing. The danger is this kind of quite nice trajectory where securities markets have been getting more finessed and the rules have been getting better. You package it up in a big red bow and it's CMU and everybody's gung-ho for this. There are tensions there are ambiguities there, which I guess all of us will be talking about today, that I think bring risks. So just a couple of, close on this, just a couple of comments about the risks with this big shiny project. Now, I think the first one is, and I'm sure many people, this isn't a particularly new thing to say, but this capital markets union, can you do this with a regulatory lever? Can you move so quickly from a system that is 70% based on bank funding and 30% based on securities market funding, and you flip that really quickly using regulatory levers? No, you can't, is the quick answer to that. And what's interesting is, prior to the crisis, when all what I would call the single market in capital reforms were going on, there's an acknowledgement of that. It's very clear. You get this sort of sense that, yeah, we can facilitate capital raising, but we can't make it happen. And a lot of the evidence that came through from the FSAP era, so 1999 to 2004, that big regulatory era, is pretty equivocal on whether or not regulation, in addition to facilitating capital raising, can actually make it happen. So I think there is definitely a question there. Obviously linked to that, and we all know this, there is entrenched institutional divergence in the EU market. We have huge varieties of capitalism, bank-based systems, market-based systems, nothing new there. We have different taxation incentives, we have different sources of capital. For example, the bond markets in Italy are hugely different to the bond market in the UK. You get massive household investment in Italy, you get very much a wholesale market in the UK. The other thing that worries me is there are fundamental structural issues out here. So at the moment, there's an awful lot of regulatory concern, particularly at the Financial Stability Board, but also the IMF, about bond markets right now. There are issues and worries about illiquidity and volatility. There's serious concerns about the major prop traders, the buy side, supporting markets correctly. There's a concern there's not enough capacity to keep bond markets stable. So if we're going to put more pressure on the bond markets at a point where they're a little bit unstable, I think that's concerning. Pushing the securitisation market for SMEs. Now, most of the city people I've spoken to said there never was an SME securitisation market. It never was there. So it's unlikely to kind of, be constructed now because they're not sure the market capacity is there. If we can do this through law, it's different levers. It's taxation, how you fund equity how you tax equity versus debt. It's insolvency. It's things like portable pensions that can easily operate cross-border. But the slight concern is here we bail into the low-hanging fruit, which is crowdfunding and prospectuses. But is that really going to get us where we need to be? This concern that it creates this momentum, this regulatory momentum. We're all charging down a road, but are we really going to go somewhere? Regulatory borrowing. I'm very concerned about references to the Jobs Act. That's a completely different institutional context. One or two more slides. The Prospectus Directive, which I know is going to be spoken about later, I really worry about this one because if you had to pick out the one piece in European securities market law that works, the one piece that pretty much everybody agrees on, is the Prospectus Directive. You talk to most market participants, most regulators, they're broadly happy with it. And yet this is becoming one of the centerpieces of the CMU reform. So that's essentially what that slide is saying, some concern about that. The rhetoric on the retail side is a little bit concerning. The household investor becomes a risk capital supplier. Now, it's very clear, EU households save, but they don't invest. They do have deposits, they do have mortgages, but they don't invest. Now, if you want to change that, that's a very, very complex and difficult process. And you have to keep in mind how you protect the retail community under that sort of policy. So what kind of retail market do we want? Do we have the evidence about this? Could we build a European pension? Is that even possible? The UK, for the last number of years, very long time, has been trying to construct simple products with exactly a view to this, to get households more engaged in the markets. It is extraordinarily difficult, both legally and from an industry perspective. And then just 2 more points. And one of the biggest worries I have about it is institutional destabilisation. So I think we have this very, very fragile, very kind of unstable ecosystem right now. And we all know there's banking union, there's the ECB, there's the European Banking Authority. How on earth is this going to figure its way out? It's all very, you kind of look at it and it's fine, you poke at it a bit and it begins to wobble very quickly. And that equilibrium is broadly okay right now. But you inject this sort of capital markets, and do we have a single institutional structure? So a couple of weeks back, the 5 presidents' reports, the presidents of the major 5 European institutions, the ECB, the Commission and so on, they reported on EMU and CMU, and they put out there, should we think about a single securities regulator? Well, look what we're looking at, a completely different population of actors to banking. Banking union is banks. Capital markets is investment firms, funds, CCP, securities markets, shadow banking, money market funds, retail investors. You know, it's a huge population. The cross-border footprint is different. Banks tend to operate through subsidiaries, securities markets tends to be branching in services. Resolution, we're nowhere near. Conduct and supervision tends, you need to be close to your local supervisor. So I think there's a danger of destabilising what the structure looks like. And I think a massive distraction risk. There is some quite boring housekeeping that needs to be done. We need to calibrate the current rule book, fix the incoherencies. So for example, we do not have a proper definition of capital. Although we have a single supervisory mechanism, we have different approaches to what bank capital is. So that has to be sorted out. I think distractions from kind of ensuring the institutional structure works, distraction from an urgent need to build better data and collection and assessment mechanisms. So Nicholas asked us to think about policy prescriptions. So I'm going to borrow from the Hippocratic Oath and essentially say, first, do no harm with CMU. There's a lot of very unglamorous work that is still needed on implementation, convergence, supervision, enforcement, and regulatory correction, none of which is interesting from an institutional perspective or from an agenda perspective, but it's very important and there's particular need for concern about the third country access issue. So thank you very much for your attention.